Hello, and welcome back. And this is part 2 of Chapter 3, The Adjusting Process. I am so glad you're continuing this journey with me as we dive deeper into the adjusting process. In this video, we will build on what you have already learned and explore how adjustments keep financial statements accurate and up to date. Don't forget to like, subscribe, and comment below to let me know what you've learned so far. In part 2 of this video, we will take a closer look at 3 key concepts that keep accounting accurate and consistent: the time period concept, revenue recognition, and the matching principle. You'll learn what they mean, why they matter, and how to apply them when preparing financial statements. The time period concept means that a company's financial activities can be divided into specific reporting periods, such as months, quarters, or years, to measure performance accurately. Most businesses use a 12-month fiscal year, and when that year runs from January 1 to December 31, it's called a calendar year. Some companies, however, choose to start their fiscal year after a slow season. For instance, retailers like Walmart and JCPenney often begin their fiscal year on February 1st and end it on January 31st, right after the post-holiday slowdown. The revenue recognition principle guides accountants on when to record revenue by requiring a structured 5-step process. Step 1. It begins with identifying the contract between the business and its customer, an agreement that establishes legal rights and obligations. Step 2. The company must identify the performance obligations within that contract. These obligations represent the specific promises made to deliver distinct goods or services to the customer, which form the basis for recognizing revenue as those promises are fulfilled. Step 3 involves determining the transaction price, which is the total amount a company expects to receive in exchange for providing goods or services to a customer. Step 4 requires the company to allocate that transaction price across all the performance obligations in the contract. When a contract includes more than one promised good or service, the total price must be divided among each obligation based on their relative value. Step 5 is to recognize revenue once the company fulfills each performance obligation. This happens when the business transfers a good or service to the customer, and the customer gains control over it. At that point, the company records the portion of revenue that corresponds to the specific obligation that has been satisfied. The matching principle, also known as the expense recognition principle, ensures that expenses are recorded in the same period in which they help generate revenue. In other words, expenses incurred during a specific month are matched with the revenues earned in that same month to accurately determine the company's net income or net loss. Some expenses have a direct connection to revenue. For example, if Smart Touch Learning pays sales commissions to employees who sell its e-learning services, those commissions are recorded in the same period as the related sales revenue. That wraps up Part 2 of Chapter 3, The Adjusting Process. Today, we explored how the time period concept, revenue recognition, and matching principles work together to ensure accurate financial reporting. These concepts form the foundation for understanding adjusting entries and preparing reliable financial statements. If you found this lesson helpful, be sure to like, comment, and subscribe so you don't miss Part 3, where we will explain the purpose of and journalize and post adjusting entries. See you in the next video.